Welcome back. You're still tuned into markets today on CNBC-TV18. The fourth headline this evening shares of all 7 listed Gujarat PSUs rallied in trade today. The state government announced a mandatory dividend distribution policy for state public sector units. The government has directed these companies to declare minimum dividend of 30% of profit after tax or 5% of the net worth, whichever is higher. Sonal Bhutra is here with more.
Thank you so much for that. A big move is what we have seen across these stocks today in trade. That is because the government of Gujarat, they have changed their dividend allocation policy or ways to reward the shareholders of these companies as well. In their policy note, they say that in terms of dividend, the companies should be paying 30% of PAT or 5% of net worth, whichever is higher, to the shareholders. And in terms of the buyback, a PSU which has at least net worth of 2,000 crore rupees and cash and bank balance of 1,000 crore rupees should go ahead and issue and announce a buyback as well. For bonus shares, the surplus and reserves, if it's equal to or more than 10 times of the paid up share capital, and they can do a share split if the market price or book value exceeds 50 times of its value currently that they are stating as well. There's 7 of them. All of them are up and buzzing in trade on the back of an expectation that maybe, yes, now the shareholders will be rewarded at a higher level. Now, I just took a look at all the financials of the companies as well as to whether they do qualify for this or not. And there was an interesting take that GNFC is the one which can actually do all the things that the Gujarat government stated in its policy document. They have a cash of around 1181 crore rupees. They have profits of 1704 crore rupees, and they have a net worth of around 7991 crore rupees. So they will be able to meet all the criteria that is set by the government without taking any stress on their balance sheet as well.
Okay, all right, Sonal. Thanks very much for that. Well, let's move on to the 5th headline this evening. Rallis India tumbled over 4% after recording an over 69 crore net loss for the 4th quarter. However, the company's revenues grew 3% on a yearly basis. Sonal is still with us. She gets us more.
Focusing on Rallis India today because that stock is under some pressure. This fall is not big, but the numbers are really weak for the company. Yet again, it's a consecutive weak performance by the company, and this time around losses have in fact widened despite whatever the industry has been seeing. Now, losses have widened. That is because of high cost inventory and higher expenses which have dented performance. Revenues are up 3%, but EBITDA loss has come in at 66 crore rupees, which compares with 3 crores in the year gone by. Loss has come in at 69 crores versus loss of 14 crores, and gross margins, they are down 800 basis points, coming in at 26.7%. The company says exports are down 25% YOY, they are down 7% sequentially, and domestic crop protection business also reported flat YOY growth, and there was an impairment cost of around 23 crore rupees, which was accounted for in this quarter as well. So there were a lot of one-offs as well that impacted company's performance in this quarter. The company recently, in fact, a few hours back, did their conference call where they said 14% revenue jump was supported by 8.5% price growth and 5.5% volume growth. However, pricing has peaked in FY23 according to the company. It has softened and is expected to decline going forward, and that is a point to worry for the markets and the company. High channel inventories in domestic as well as international markets is what they saw, and they expect volume-led growth, but there will continue to be pressure on margins due to high channel inventories. So high channel inventory, that's a problem that's happening across the agrochemicals and the chemical space as well. They expect to scale up products which they introduced recently. They're focusing on new product development, marketing and distribution as well. And for FY24, the capex is 150 to 170 crore rupees, where they are also expecting last phase of their multi-purpose plant to be completed very soon. So the key takeaway is they expect margin pressure to continue, and that is something which could worry the street because they've not been performing well for last couple of quarters, and that has continued now as well.
Okay, all right, Sonal, thanks very much for that. Well, let's move on. Multi-commodity exchange MCX tanked close to 8% on the news that the company's chief technology officer has resigned. Another person will take over as the interim CTO. Surbhi Saratia joins in with more details on this.
Thanks so much for that. So MCX is reacting today, and that is because their Chief Technology Officer, Mr. Shashank Sathe, has resigned. And in the interim, Dr. N. Rajendran, the Chief Digital Officer currently, will be taking over. But the main concern for MCX is regarding their implementation of the new tech platform by TCS. Now, MCX was supposed to switch to TCS as a software service provider last year, but that did not happen, and they have extended their current contract with 63 Moon Technologies till June of 2023. Which is why their software support expenses in Q3 also was up by 3 times, nearly 68 crores versus 22 crores on a year-on-year basis. And this pain of escalated software costs was going to last another 2 quarters. In Q3 con call, management did seem confident of launching their new platform in Q1 and switch successfully to TCS as a software provider, and they were going to plan more mock sessions in Q4 and Q1. So till the switch doesn't happen, that overhang is going to remain on the stock.
Okay, all right, Surabhi, thanks very much for that. Well, in other news then, the latest on Reliance Capital resolution saga, the second round of the auction has concluded, and sources say Hinduja Group was the only bidder to participate. Ritu Singh has been tracking the story. She joins in with more.
That's right, Ekta. This is the second round of auction for the company. After a lot of legal issues, the matter is still pending in Supreme Court, and anything that happens in the second round will be pending the outcome of that Supreme Court order, which is only expected much later in August. That said, the second round did take place today. There were 4 suitors, but only one came forward, and that is Hinduja's IIHL. They've made an offer of 9,650 crores. Is what we've been given to understand. Surely an improvement over the previous round, where Torrent had emerged as the highest bidder with an offer of 8,640 crores, and also an improvement on the revised offer that Hinduja had tried to make at about 9,000 crores. And all of this is in net present value terms, but this still remains far lower than the liquidation value, which is pegged at around 12,500 to 13,000 crore rupees for Reliance Capital. In this round, the base bid itself was set at 9,500 crores. So this offer is not much higher than that. But the good news is it is all in upfront cash payments. So that's one relief for the lenders. Now, Torrent, Oaktree, Piramal, none of the other participants came forward to submit any bids in this round. Torrent's matter, which had challenged the second round, is still pending in the courts. Now the question is, will the lenders accept this and move forward to submit this in the NCLT for its nod, or will lenders renegotiate? That had been one of the biggest concerns of the suitors so far. As of now, a bit of a relief that they've at least got this one offer from the company. Remember, the total outstanding claims are over 25,000 crores. So even with this offer, we're looking at a haircut of more than 60% for the lenders involved.
Okay, all right, Ritu. Thanks very much for that. Well, on that note, it's a wrap on this edition of Markets Today. We leave you with some more market opinion from Mihir Vora. Thanks very much for watching.
Pharma, our preference is more towards the domestic market, because that's where you have some pricing power and branding benefits, distribution benefits. As far as the US market is concerned, the call every year is whether the worst of the generic price erosion is over. And while we have seen some moderation in the rate of decline, which is decline in the rate of decline, but it's too early to say whether the worst is over. We are still probably not past the sharpest US recession quarter. So you might see some more deceleration in US corporate spending, retail spending, etc. So maybe things get a little bit worse before they get better. So I would be more cautious on US tech spending and by corollary the Indian IT services space.